For practitioners of smart money concepts and ICT methodologies, the technical foundation begins with locating specific down-close candles to draw structural order blocks. The standard retail execution sequence is straightforward. You project a box from that candle, place a limit order exactly at the midpoint, and tuck a stop-loss just below the structural low. This standard setup demonstrates how rigid geometric execution frequently fails. Price action slices directly through the box, sweeps the stop-loss, and instantly rockets upward. The immediate reaction is psychological frustration. Traders assume the broader market is rigged or that their broker is actively hunting stops. The failure of traditional SMC order blocks comes down to a structural flaw. They are static, geometric exercises that completely lack underlying real-time order flow telemetry. Drawing a precise geometric box on a chart does not obligate an institution to defend that specific price level. A vast majority of these textbook candlestick formations occur during periods of low volatility noise, such as lunchtime trading chop. Institutional trading algorithms often interact with these common candlestick patterns as a means to consolidate orders. In a high-frequency environment, these predictable retail entry points serve as efficient pockets of liquidity. By triggering a cluster of stop-loss orders just below the box, an institutional algorithm can generate the necessary counterparty volume required to fill a much larger position without significant slippage. Moving beyond the visual shape of a candle requires integrating dynamic wave classification into the entry criteria. Without properly measuring real-time momentum and volume, a static order block is a geometric projection lacking the data necessary to confirm if a level is being defended or simply ignored. Our quantitative engine enforces a strict foundational rule: no wave, no order block, no trade. We filter raw price action through 3 simultaneous dynamic parameters to mathematically prove institutional intent before a trade is considered. This interface breaks down a live price sequence by separating it into the 3 specific data layers required for structural validation. The first parameter utilizes MACD to measure the baseline wave momentum moving through the asset. The second parameter applies average true range, or ATR, to prove that a genuine volatility expansion is taking place. The third parameter monitors volume asymmetry, tracking the explicit imbalance between buyers and sellers to confirm structural order flow. A valid trigger condition occurs exactly at the moment the volume asymmetry metric breaches a strict greater than 0.40 threshold. Only the exact simultaneous convergence of these 3 metrics proves that aggressive institutional market orders were executed, separating genuine movement from algorithmic background noise. The system visually translates the validation of these 3 parameters into explicit structural states directly on the chart. Looking at this confirmed setup, we see the first structural state, the primary ignition point of institutional momentum bursting from a zone. A true C signal prints, anchoring a thin dashed orange midline directly to a 50% tag on the right-hand price scale. Following this ignition, the system deploys a Kaufman efficiency ratio, or KER, look-back window to monitor for secondary market actions. This specifically tracks whether secondary institutional buying occurs within a concentrated period directly after the primary breakout. This secondary buying surge triggers a nested true C signal. The thick dotted orange midline indicates a zone of secondary capital commitment occurring within the established Kaufman efficiency parameters. These extended midlines lock precise reload coordinates directly onto your price scale. By enforcing this mathematical hierarchy, you eliminate chart clutter and subjective guessing, leaving only a structurally sound institutional entry coordinate. Identifying a valid block is only the first step. The second major point of failure is manual position sizing, which consistently leads to over-leverage. Most traders apply static contract sizes to indices trades, ignoring the fluctuating volatility and actual structural width of the specific order block they trade against. This live telemetry HUD provides the solution for dynamic capital preservation. It tracks raw inputs, taking a $50,000 account and locking the maximum risk strictly to 1%, or $500. Instantly upon signal generation, the HUD mathematically measures the exact volatility distance between the true C 50% entry line and the required structural stop. The algorithm then factors in the specific instrument's tick value in real time. The output instantly generates the exact contract payload required for that specific setup. This automated engine removes all manual calculation during fast market execution, permanently locking your maximum dollar risk regardless of the trade's structural width. This risk engine scales effectively across boundaries using multi-timeframe or MTF mode. This allows a trader to execute a 1-minute chart setup perfectly anchored inside a wider 15-minute MTF order block. This provides wick insulation. By utilizing the macro structural boundary of the 15-minute chart, you avoid the lower timeframe micro wicks that prematurely trigger tight local stops. This split-screen chart illustrates the mathematical dilemma of using a wider stop-loss without increasing account risk. On the left, a 10-point order block requires 2 contracts. On the right, anchored to a wider 25-point structural block, the payload automatically drops to 1 contract. On both sides, the $500 risk limit remains static. Because the 15-minute structural stop spans a wider price distance, the algorithm must scale down the total number of contracts to maintain the fixed dollar risk. The HUD handles this payload reduction instantly and automatically. Multi-timeframe execution grants macro-level structural stop protection without risking a single extra dollar of account capital. 3-parameter wave classification filters out algorithmic traps, proving real institutional market execution. The 50 turning off the retail noise and locking into a fully mechanical, data-driven risk engine provides the sustainable foundation required to exploit institutional order flow and survive modern quantitative markets.